Welcome. In this video, we will analyze if XRP coin is ready to take flight. Don't forget to subscribe, like, and please watch to the end to understand. The rising trend line coming from the lower side stands out due to the strong reactions it has received from the previous two touch points. This level can be considered as a support zone in the market and is seen by investors as a key buying point. Reactions forming above this rising trend line typically signal that buyers may push prices to higher levels. If the price approaches this rising trend line again, it means that buyers will have the opportunity to test this level once more. Prices that have previously touched this line received strong reactions, and the movement continued upwards. Therefore, it is expected that prices approaching this level will also face a similar response. For investors, when the price reaches this level, it could indicate a potential buying opportunity. This rising trend not only provides a short-term response, but can also impact the overall market direction. Maintaining the rising trend could lay the groundwork for the continuation of a long-term positive trend. Reapproaching such levels can allow investors to make safer predictions about the market's future. The strength of this trend line as a support level also indicates that buyers are dominant in the market, preventing prices from falling lower. Once the price approaches this level again, it is highly likely that buyers will step in and push the price upwards. The previous touch points of the rising trend line show that the price tends to stay at this level or even move toward higher levels. If the price tests this level and receives an upward reaction, it would signal the start of strong buying pressure in the market, and prices could begin rising significantly. Furthermore, each touch of such levels not only affects the short-term direction of the price, but can also increase investors' confidence levels. Investors who analyze the reaction at these levels accurately and position themselves with proper timing can take advantage of potential profit opportunities. If you plan to buy, you may want to wait for the price to touch this rising trend line, as an upward movement could follow after the touch. Elliott wave theory is a powerful tool for analyzing market movements and developing accurate strategies. The foundation of this theory is based on the assumption that market movements follow a specific pattern. Prices typically move in a five-wave upward movement. The first and second waves represent the correction and preparation phase in the market, while the third wave is typically the strongest and longest wave. These three waves are generally the part that holds the most potential for the largest gains in the market. Currently, the first wave has been completed, and the market is in the second wave. However, there are several reasons why the second wave doesn't immediately transition into the third wave. The second wave is usually seen as a correction phase in the market. During this period, investors expect prices to pull back to a certain level, and uncertainty in the market increases. This is because, after making gains in the first wave, investors generally want prices to drop again and reach a more secure level. At this point, prices move sideways, and investors continue to wait. However, this sideways movement presents an opportunity for investors. While prices are falling during the second wave, many investors get the chance to buy at lower levels. This could be an important opportunity to make significant profits once the third wave begins. When the third wave starts, the market usually gains strong momentum, and prices move upwards quickly. This wave is considered the one that brings the largest gains in the market. Investors typically establish long-term positions once the direction of the market is clearly determined. Once the third wave begins, the yellow and green lines, set as targets, are the levels that prices should reach. These levels are technically determined targets and are often aligned with Fibonacci levels. Such targets show investors how much profit they can potentially make, and when that profit may occur. The third wave is generally a process where prices rise very quickly, momentum increases, and the direction of the market becomes clear. This creates a significant opportunity for investors. The sideways movement in the second wave can actually be seen as a preparation phase. During this time, patient investors wait for prices to pull back to the correct level, and then open positions at the right time when the third wave begins to profit from it. Since the second wave offers price lows, investors buying here will benefit when the third wave begins and prices start rising. What's important for investors to understand is that these corrections and sideways movements are only a transition period, because the third wave that follows holds the potential for very large gains. However, in order to achieve these gains, it is crucial to take the correct position at the right time. Transitioning to the third wave takes time, and patience is required. The current downtrend on the RSI indicator shows weak momentum in the market, or that prices are continuing to slide downward from a certain level. However, the key point to focus on in technical analysis is the potential for the RSI to break this downtrend and start moving upward. Such breakouts can often signal significant changes in the market. In particular, When the RSI breaks its downtrend, it can be interpreted as a signal that the market is beginning to gain strength. This breakout not only indicates a technical shift, but also suggests that price movements might gain upward momentum. Since the RSI tends to move in parallel with prices, this breakout could pave the way for prices to rise as well. The RSI breaking its downtrend could trigger a new buying wave in the market. Investors may be inclined to buy when they see such a breakout, believing that prices have the potential to climb to higher levels. This creates a positive sentiment in the market and often leads to a strong upward movement. In technical analysis, when the RSI breaks a trend, it generally indicates that momentum is increasing in the market and that more buying pressure is building. The RSI breaking its downtrend and moving upward could also provide short-term support for prices. If the RSI moves upward after the breakout and sustains that movement, it could signal the start of a rally for investors. Prices may rise more strongly because the RSI typically moves in parallel with price movements, and as prices go up, the RSI also rises. These scenarios can influence traders' decisions and lead to more buying in the market. Another important point is the possibility of the RSI gaining natural momentum with this breakout. Investors may see a potential trend reversal at the point where the RSI breaks its downtrend and may be more likely to buy. This could create an increase in market momentum and lead to a rapid rise in prices. Such situations are typically associated with the market recovering from previously weaker areas. Once the RSI breaks the downtrend, prices will likely take off. The vortex indicator is a valuable tool for investors to understand the strength and direction of market trends. When the blue line crosses above the red line, it is considered a strong signal of an upward trend. This typically indicates that the buying side is gaining dominance, and that the market is gaining upward momentum. Currently, the blue line is very close to the red line, which suggests that a potential market reversal may occur in the future. However, for this reversal to turn into a genuine uptrend, the blue line needs to clearly cross above the red line. If the blue line crosses above the red line and this move is confirmed, it will indicate that buying pressure is increasing and that investors believe a positive trend is beginning. This could lead to a rapid increase in new buying activity, pushing prices quickly upward. Additionally, such a move often impacts the overall market sentiment. When investors see this signal, they typically prefer to enter the market because it suggests that higher price levels could be reached in the future. The blue line rising in the vortex indicator can be a strong signal of the market's strength based on technical analysis. Investors can use these signals to make better decisions. For example, opening a buy position when the blue line crosses the red line is a common strategy that increases the likelihood of a rise starting. Moreover, price increases that follow. Such a movement usually happens quickly because the market gains momentum, and more investors notice this and take action. The importance of this transition in the vortex indicator is not only technical, but also significant from a market psychology perspective. When investors notice that an uptrend is beginning, they tend to be more inclined to buy, which creates additional buying pressure. This, in turn, leads to faster upward price movements. The blue line crossing above the red line also indicates increased market confidence, with investors being more willing to take on risk. This confidence directly influences market participants' decisions to buy. A breakout like this in the vortex indicator can be an important opportunity, especially for technical analysts. Investors can use these signals to implement a buy strategy before prices rise. Additionally, the vortex indicator can help identify which trend the market is currently in. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.